Well, how do you finance in today's real estate markets? How do you get pre-approved? How is credit card debt handled by the mortgage companies? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, the real estate markets have been all over the place, but today Mortgage Mark is here to talk a little bit about how to be successful in getting approved for a note and get you well on your way to buying that first house or buying a different house. Mark, welcome to the program.
Thank you, Mr. Bob. Thanks for having me, as always.
Just so that people know, Mark comes on the program every month, and we talk about the real estate. We've been doing it for a very long time, and he brings a lot of great information to the program and to the listeners. Mark, it wouldn't be right if I didn't start off with asking how the market's doing, and it's really interesting. I thought about you when the Federal Reserve Board lowered interest rates, and I was hoping, okay, interest rates go down, interest rates go down, and they went up. Were you expecting that, or were you going, I can't believe this is going on, this is happening this way? Well, what were your immediate thoughts?
Yeah, good question, and that is, it kind of goes back to market theory in the sense that the reason why they went up essentially is that the mortgage rates already came down in anticipation of the Fed making that cut. So, for example, after today, I saw a stat this morning, the October meeting, there is a 99.3% chance right now for the betting folks out there. So call it a 100% chance of another cut coming in October, and then I think it was like an 87% chance for December's cut. So the reason why I share that with you is the market is now expecting that to happen. So that means both the stock market as well as, call it the bonds and mortgage market. So our rates are going to respond in anticipation of that. So to your question, when you said, when the Fed cut rates a couple of weeks ago, we'd already seen a move lower in rates, a pretty good one, for about 3 or 4 weeks leading up to that because the market was already expecting it. So it's not uncommon for the market to go mortgage rates to go up after a Fed cuts, because a lot of it has to do with what the Fed says in their statement thereafter. Right. So we'll see, but again, supposedly at this moment, it's a lock for October's cut, and we will see how mortgage rates respond. But the government shutdown kind of made a little wild card. Well, I don't think it'll be forever, obviously, but the reality is the next couple of days will be interesting to see how this plays out and what impact that may have on rates.
So, over the past month or so, how has the market been adjusting, buyers and sellers wise?
Yeah, good question. So the good news is with those rates coming down. So let's call it early February, late October, early February, or not October, sorry, beg your pardon, late August, early September, as rates started coming down. Rates right now, if you look at MortgageNewsDaily.com or FreddieMac.com, you'll see rates publicized for low sixes, 6.3, 6 point whatever, which is lower than what it was a couple weeks back. So the good news is it's created a little bit of a stir for folks to say, okay, a lot of refinance activity for sure, but more activity. We see more folks with the realtors on the weekends and the builders we work with where activity's starting to pick up a little, but overall it depends on where you are and what neighborhood and community, but it's still a little bit of a buyer's market right now. So it's still slower than what we'd like as an industry, no doubt, but we have seen it pick up just because that rates have ticked a little lower now.
And then you have a government shutdown to make it a little bit more interesting.
Yeah, so
we'll see how that.
Clear, the government shutdown. Because I've had a lot of questions. My kids asked me last night, "Daddy, what does that mean for you?" And I'm like, I appreciate you girls thinking of me. But the reality is, for this very moment, for the vast majority of loans, it's still business as usual. There's going to be some impact, but if this is still around next week or 2 weeks from now, maybe a different story. But for right now, I'd say the overarch, just to keep it simple for today's conversation, big picture, most loans that are going on right now are not impacted by the shutdown yet. Again, who knows 2 weeks from now if the IRS is still closed and tax transcripts and all these other things take longer to get, we'll see. But for the moment, business as usual, and rates haven't really done a whole lot the last 24 hours just because, in reaction to the shutdown. So that's good.
It's interesting because you don't really take a step back and think about what does get shut down. I mean, you think of the essential services like the Social Security and that kind of thing is still running, but tough to get something from the IRS if the IRS is shut down. And there's a lot of
1,400 families are affected each day by FEMA not being around. So flood insurance now, North Texas, not that big a deal, but Houston and the Gulf Coast region,
right?
There's a lot of folks trying to close on homes and they can't. Yeah, as of yesterday and today. So we'll see. That's a lot of folks. That 1,400 times however many days is a lot of people.
Well, what we like to do is kind of go back to the basics. And what I wanted to do today, Mark, is to talk a little bit about the process of getting approved. And it goes without, and I'll let you comment on this, but it goes without saying that if you're going to go start the process of looking at houses, it's probably the number one thing that you got to do up front is make sure that you're not going to have any problems getting pre-approved. Get with that mortgage consultant.
Bob, I shout this from the mountaintops, and you're absolutely right. Reason being, you don't want to spin your wheels or that of, whether it's a seller or a realtor you're working with. You don't want to just go out there and waste your time or theirs if you don't know what you can afford. So I do recommend reaching out to a mortgage professional, someone you know, you like, you trust, right, and just having a conversation and taking those steps to get pre-approved. I mean, yes, it may take you, call it 30 minutes initially for the conversation, then another 30 minutes to an hour to go through and get everything wrapped up. But the good news is, once you've done that, you know exactly where you stand, and then you can go out and start looking at the homes that you can actually afford and want to purchase. So I think that's the number one thing, is to find that person you know, like, and trust. Take the time and do it up front. It's not fun. I'm in the business. I get it. It's not fun. I'd rather go get a root canal. But the reality is, doing your homework and doing your paperwork up front, it goes back to that old adage that ounce of prevention is worth a pound of cure. If you do your homework up front with a mortgage professional that takes the time to do it with you, not these 15 minutes and you're done people, but if you actually take the time to submit your paperwork and get reviewed, it will save you a world of hurt. And you can make an average mortgage loan officer look great if you just do your homework up front with them to give them time to respond to any trouble that may come about.
Mark, to add to that, it's something I think people don't really think about. By bypassing the appropriate process and leaving the mortgage consultant we'll get to it. You're undertaking a very emotional process that to go into a process of looking for homes and falling in love with a home. You really do need to know ahead of time, do these numbers fit my numbers?
It's so true, and it goes back to the part about what you just said. I mean, there's, when it comes to numbers, it's hard to get emotional over a payment, right?
Right.
In other words, hey, Mr. Smith and Mr. Buyer, here's your proposed payment, here's your closing cost. It may get emotional and let you get a little grumpy, but the reality is, knowing that piece prevents the letdown or the heartbreak. Because here's the reality: you can do it backwards. Anybody can go out there and, they can call a realtor, they can go online, they can start looking. They don't have to get pre-approved first. Nothing's going to stop you from doing it in a different order. But man, the emotional, we hear it in their voices. Hey, I found a house and I love it. It's the dream house. Cool. They start running numbers. All of a sudden they can't afford it. And then they spend a week trying to figure it out. They call mom, dad, brother, sister, aunt, uncle, boss, whatever. And then ultimately can't get it. And they're heartbroken. And I understand it's a moment in time. There's certainly worse things in life than that. But the reality is, it's unnecessary. Do your homework first. Be disciplined. Be prudent. Do what you should do first, which is the stuff you don't want to do, which is do the mortgage application and get pre-approved first, and talk to somebody again that's going to shoot you straight and take care of you. So I think that really is step number one.
So let's talk a little bit about situations that the mortgage companies may not like, and we'll start with a low credit score. What's a credit score that's really the bottom of the rung that you need to be above to even be in the talks of the process?
Yeah, so I will answer that directly, but I'm going to set that up with a qualifier. Mortgage credit scores, because we get this a lot, mortgage credit scores are going to be lower about 50 to 75 points on average, or it's kind of that's typically what we see, than a consumer credit report. So I think it's important to state, because people call us and say, oh, my credit score is X. Well, not really. That's what their credit monitoring system says, or that's what their credit card monitoring system says. That's not your mortgage credit score. And the reason is, mortgages, we have a lower grading scale. So our grading scale doesn't go as high as the consumer side. So that's why our scores are lower. It's not because it's worse or that we're negative. It's just a different scale and a different scoring model. So let's qualify that first. So to answer your question, kind of where's the credit score for entry? Various programs have various requirements, and some can let you do this and some let you do that. But I would say in general, if you have something in the 600s, you can play ball. There's programs out there that even go down to 580. I would say a lot of times, and I know we're going to get to the piece that you led to in the on the start of this program, is credit cards. But there are little things you can do to move the scores. Some of them are quick, and some of them are easy. Some of them may take 30, 60, 90 days. But to answer your question just straightforward, I wouldn't rule it out. I talked to a mortgage professional, because it's kind of the old adage of there's no such thing as no, there's just not yet. So even if somebody says, I just went through a divorce, because divorce and medical reasons are a lot of times why you see the scores beat up. And let's say you got a low 500, mid 500. Maybe not today, but there could be a plan in place that says, okay, fix this in 6 months or 12 months or 18 months to be back and ready in the game.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you want more information about Mark, he's got a great website, www.mortgagemark.com. Let's talk a little bit about bankruptcy. That's got to be a hard no.
Believe it or not, it's not. You could be in bankruptcy, depends on the bankruptcy, but you could literally be in bankruptcy with permission from the court, and you can still buy a home. So, again, that's why I just say there's so many programs out there, and that's not a universal statement, right? Not every program is going to allow that, but the reality is there are programs that can and will. Some are going to say, hey, depends on the bankruptcy. 1 year out of bankruptcy, you can do it, or 3 years out of bankruptcy. Same for foreclosures. They could be different timelines for different programs. So I would just say, unless you're in the mortgage industry and you are a mortgage lender, then but if not, don't pretend to be one at home. Call somebody. And there's no real obligation. If somebody makes you pay for something up front, call somebody else. But to talk to somebody, a mortgage professional, to figure out what you can do and when you can do it, should cost you no dollars. It'll only cost you time. Whether it's 30 minutes or an hour and a half, it will take you some time, but ultimately get the correct answer. Don't make the decision for them. At least know what you can do. It doesn't mean you have to move forward. Like if a lender guy says, hey, congratulations, 2 thumbs up, doesn't mean you have to go buy a house tomorrow. You at least know what you can do. So even if you think you might be getting ready and that itch is there, have that conversation. It's no obligation, and this is what we do as a living for professionals. Like as mortgage individuals, we want to help educate and inform folks for what they can do.
A long time ago, you said on the program, you probably don't remember this, but this was a while back, but you said, don't try to get cute and manipulate the numbers. I mean, the bank wants to see cash and savings accounts and things like that, and borrowing money from your parents to put money into your bank account. We're going to figure that out.
We will, and look, here's the deal. I do remember, I don't know when I said that, but the reality is that is something I tell folks on a regular basis, and it kind of goes back, and this could be a good segue into the credit card piece. Don't do anything before you call a mortgage professional. Talk to somebody in the business and get a game plan, because I do have folks trying to get cute, to use my own words. They try to do this, or they move money around, or they pay this off, or they do that. Look, at the end of the day, believe it or not, some of these best intentions have negative impact on qualifying for a mortgage. So I would absolutely say contact a mortgage professional first, get a game plan, and be honest with them. Hey, here's what happened. I need mom or dad to do this, or I can get this, or I can do that. Some of it's unnecessary. So save yourself the work, the headache, and the stress, and get a valid plan from somebody who knows what they're doing, and then execute that plan.
It reminds me that I think sometimes people going through this process think that the mortgage company's not on their side, or the mortgage consultant's not on their side, when that's the job of the mortgage consultant, is to make things work the best that he or she can.
100%, and that's our job on the front end. So to be very clear, and I'm not saying it's sales versus ops. It's not an adversarial relationship. We're all here to make sure we do this and to do it right. And we're not trying to put anybody in a loan they don't need, want, or deserve. But the reality is, the front end, your mortgage loan officer, the mortgage professional you're speaking with on the phone, be completely transparent and show everything, because that's where trouble happens more often than not. When somebody, again, is trying to get cute, let's just use that for the catchphrase of the day, and they try to hide something, we will figure it out. And the thing is, if I figure it out with you as a client, like you as a client can tell me what's going on, we can address it before it goes to underwriting. Our job, my job, is to make sure that we got everything structured and buttoned up. The underwriters, believe you me, they're the ones trying to figure out how not to give the loan. And they're just trying to make sure that things are not, that's not the right way to phrase it, but their job is to really sift through and figure out what's real and what's not. And that's where we, the mortgage people on the front end, can help you and determine how do we structure this to put the best foot forward, again, in an accurate and correct way. But the reality is we're not trying to do anything different, but there's some stuff we don't need them to go looking for stuff that they don't need to go look for. Let's give them what they need, and let's get the loan done.
Let's jump into the details, because these are some of the numbers that do really matter. Debt to income. Talk about exactly what that is and where you should be ratio-wise.
Yeah, good rule of thumb. So so DTI, debt to income. Now, when people say how much home can I afford, that's really, I would say, the number one thing that's going to dictate it. Yes, credit matters and all that other stuff. But at the end of the day, how much can you afford is debt to income. So if you take your monthly debt obligations, and what I mean by that on the mortgage side, whatever your debt obligations are that show up on a credit report, your credit cards, your student loans, your car loans, and all that, and then obviously a potential mortgage payment, add all those numbers up, that's your total debt for the month, and divide it by your total gross income, meaning pre-tax. So let's keep numbers easy. If somebody makes $120,000 a year as a household, that's $10,000 a month. If the mortgage payment, car payments, credit cards, all that equals $4,000 a month. Take the $4,000 of debts we just talked about, divide by the $10,000 of income, and that gives you a 40% ratio, debt to income ratio. And so, Bob, you asked the question, what is that limit, or where do people like to see? Generically speaking, 40 to 45% is kind of where most programs are going to ask that you, or kind of require that you be somewhere in that 40 to 45%. There are programs that allow you to go above the 45%. And by the way, there's programs that even can say they ignore that ratio completely. That's a tale for another day. But to answer your question, below 45% is a good target. Doesn't mean you have to be, but it's a good target to use.
So, talking about cash flow, are there any particular numbers or ratios that they're looking for that?
No, generically speaking, no. I mean, the debt to income ratio kind of considers the cash flow. It's nothing direct. There are, refinance for VA stuff that do require some disposable income, but that's for veterans doing a VA refi. For the rest of the world, there's nothing that says this much cash flow. It's more money in the bank, reserves, and then a DTI number. So the DTI kind of implies that there'll be cash flow. If you're at 30% DTI, that means there should be enough left over to do things. If you're at 50%, where you spend 50% of your gross income on debt, that implies there's not going to be a ton of cash flow at the end of the day, because you still got to pay your cable bill, your electric bill, and go on vacation every once in a while. So those things are not included in that debt ratio. So no, nothing in terms of true cash flow is really considered.
This is Bob Brooks, and you are listening to the Prudence Money Radio Show. Thanks so much for joining me today. If you got a question for me, please go to the website at www.prudencemoney.com. I'll get you taken care of. If you want more information about Mark, you can go to mortgagemark.com. Now, credit card debt being what it is, you've been in the business for a long time. Have you seen mortgage companies adjust differently to the fact that we are dealing with as much credit card debt in this country as we are?
Yeah, it's the highest ever, right? I know it's over $1 trillion. I don't know if the recent number, $1.2 trillion of credit card debt, which is crazy. In a weird way, Bob, like debt, all debt's kind of created equal. So, in other words, if you owe $1,000 a month of credit card obligations and you owe $1,000 car payment, to kind of keep those things the same. It's still the same $1,000 either way. But what I will tell you about the credit card debt, that is one of those little tricks for credit scores. We mentioned earlier, like what's the bare minimum to get in. A lot of times, some of the finagling, and again, talk to a mortgage person first. But some of those little tricks is your credit scores can be impacted by what's called the debt utilization. how much credit card debt you have. So to answer the question directly, mortgage companies, as far as the debt, it doesn't matter if it's all credit card debt or some credit cards, some cars, some student loans. Debt is debt, and that goes into that debt-to-income ratio. But there are little tricks you can do from a credit card standpoint to maybe help out that DTI and or improve your credit scores.
So you go through this process, you get an idea of how much of a home that you can buy, and you get pre-approved. Now, what exactly, I don't want to be Captain Obvious here, what exactly does pre-approved mean?
Yeah, so there's two terms that get thrown around, pre-qualified and pre-approved. Pre-qualified means that somebody's told me, hey, I make this much and I have this much money in the bank, and I can say, cool, thumbs up, congratulations, you're pre-qualified. Pre-approved, which is better, it's more concrete, it's more firm, it's more accurate. Pre-approved says that that person has provided documentation to verify that information. So to get pre-approved says, okay, we've kind of, we cracked open the closet on the pre-qualification, we peeked in. Pre-approved says we've opened it and we've removed any skeletons that are in there. Pre-approved, you're good. You've done the homework. And as a seller, I would want to accept pre-approvals way before I'd accept the pre-qualification. As a buyer, I would want to get pre-approved to know that I'm not going to have any 11th hour hiccups when it comes to just me getting qualified for a mortgage. So pre-approved and pre-qualified are different. I highly recommend the pre-approval process.
So in all the mortgages that you've done through the years, how many times has something snuck up through, even though you were pre-approved?
Buddy, I don't think our program's long enough for that. But the reality is, I would say statistically we get about 35 to 45% of people get pre-approved despite our recommendation for 100% of the people. And the ones that get pre-approved close quicker, close smoother. It's just easier on everybody, less heartburn. So I can tell you, to answer your question, how often do surprises come up? More than I care to admit is the answer. And it's not, again, it's just because we don't know what we don't know. And so when they submit documentation later on, that can open up another question, which opens up another can of worms. So I would absolutely, again, be part of that minority and take the extra time and get pre-approved. It's worth the extra work up front.
Okay, let's talk about the tougher category. It's the self-employed. What kind of advice and instruction can you give on that process?
So I just highly recommended that we get pre-approved up front to those individuals that are listening and thinking about buying a home or refinancing. I would say mandatory. Self-employed does the pre-approval. Because when you're self-employed, you don't know what you don't know. The tax returns could be funky. There are programs that you can do without tax returns, but you get better rate, better terms, better financing if you provide them. So provide the tax returns first. Then if we can't fit inside the box, we have time to pivot and do something else and do something different before you put yourself on a contract and only have a few weeks to figure it out. So I would almost, for us, in my world, it's mandatory if you're self-employed, just to do the pre-approval. Because, again, there's so many things we don't know, and the documentation can absolutely cause heartburn. So I recommend it for everybody, but I will stress it and hard, like pound on the desk. If you're self-employed, commission, overtime, bonus, anything that's variable, absolutely, please do yourself a favor and get pre-approved, for sure.
This was kind of a way people looked at mortgages back in 2008. Of course, that was all a really messed up period. And we've got about a minute left. But the old saying that just because you're pre-approved doesn't mean you can afford it, I would assume still applies to today.
Yeah, again, there's a lot of, in today's world, I think consumers have done a better job understanding what they want to spend. The question used to be back in the pre-07, 08, because I was around then, and they would say, how much can I afford? Today, that's not really the first question. It's, hey, like, what can I buy with this many dollars? So most folks have a generic idea. Again, they may not know exactly, but they at least have some sort of understanding or concept of what they want to spend, and then we work backwards into that purchase price. Versus back then, it was just tell me the biggest number I can go get. So you're right. Pre-approval helps put you in line and make sure that you can do everything you want to do before you go out and get excited and start looking at homes.
Mark, the website, once again, mortgagemark.com. Mortgagemark.com is the website. And great to have you on. We'll talk with you next month.
Thanks for having me, as always, Mr. Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you got a question for me, go to the website and just send in your question, and we'll get you taken care of and get that question answered for you. If you have a question for me, please go to the website, www.prudentmoney.com, and send it in because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.